The Federal Reserve has already made one of the biggest moves of this cycle, and most people don't fully understand what just happened. On December 1st, 2025, the Fed officially ended its latest round of quantitative tightening, known as QT2. After more than 3 years of shrinking its balance sheet, the Fed has now frozen it at around $6.5 trillion. In other words, the great money vacuum of this cycle has been turned off. And if that sounds technical, stay with me, because later in this video, I'll show you why this single decision, combined with coming rate cuts and a change in Fed leadership in 2026, could reshape stocks, crypto, and the whole global economy. To understand where we are, we have to go back to how we got here. The Fed has now gone through 2 full QT experiments in less than a decade. The first one, QT1, started in late 2017 under Jerome Powell's early tenure. After years of quantitative easing following the 2008 crisis, the Fed finally tried to shrink its balance sheet. It slowly let bonds roll off instead of reinvesting them. But by 2019, money markets started to crack. Repo rates spiked, liquidity vanished overnight, and the Fed was forced to stop QT and quietly inject cash into the system again. That first experiment ended with a warning. The plumbing of the dollar system is fragile. Then came the pandemic. In 2020 and 2021, the Fed went in the opposite direction. It launched massive quantitative easing, buying trillions of dollars of treasuries and mortgage-backed securities to stabilize markets. The balance sheet exploded to almost $9 trillion. That ocean of liquidity helped save the economy, but it also helped fuel the inflation surge that followed. So in early 2022, the Fed changed course again. It ended QE in March 2022 and launched QT2 in June 2022. From that point on, the Fed stopped reinvesting all of its maturing bonds. Month after month, up to tens of billions in treasuries and mortgage securities were allowed to roll off. Over the next 3.5 years, from mid-2022 to December 1st, 2025, the Fed drained roughly $2.3 to $2.4 trillion from its balance sheet. Reserves in the banking system fell. The overnight reverse repo facility, which held about $2.5 trillion of excess cash at its peak, dropped to almost zero. On paper, this looked like a successful normalization. In reality, the system was getting tight again. By late 2025, money market conditions were flashing warning signs. Bank reserves were getting dangerously low. Dealers were tapping the Fed's standing repo facility more often. Short-term funding rates were starting to behave erratically. In the October 28th to 29th FOMC meeting, Fed officials admitted it. The minutes show almost all policymakers agreed it was time to end balance sheet runoff on December 1st to prevent losing control of short-term interest rates. In other words, QT2 did not end because everything was fine. It ended because the Fed was once again bumping up against the limits of the system. Former QE critic and Fed watcher Jeff Snyder has been warning for years that global dollar plumbing can't handle aggressive QT without something breaking. Others, like strategists at major banks, pointed out that this is the second time in 10 years the Fed has tried QT, and the second time it had to stop early to avoid a crisis. So, where are we now? As of December 2025, QT2 is over. The Fed is no longer shrinking its balance sheet. It's holding it roughly steady and preparing for what officials politely call reserve management purchases, likely starting in 2026. That means the Fed will quietly start buying short-term treasury bills to make sure there is enough liquidity in the system. Technically, this isn't being branded as full-scale QE because it's focused on short-term bills and market functioning rather than long-term bonds and direct stimulus. But as Ray Dalio recently warned, if you combine a growing Fed balance sheet, falling policy rates, and large government deficits, you're getting very close to classic debt monetization and bubble territory. At the same time, the Fed has already begun cutting rates. In October 2025, it lowered the federal funds rate by a quarter point to a range of 3.75 to 4.0%, and a strong majority of surveyed economists expect another cut in December, with more easing likely in early 2026. Wall Street houses like Morgan Stanley and others now see the Fed moving towards something like a 3% terminal rate over the next couple of years. The OECD, the Organization of Major Economies, projects that the U.S. will end its cutting cycle by around 2026 with rates still higher than they were before the pandemic and with growth slowing to under 2%. But this is not just about rates and balance sheets. It's also about power. Who runs the Fed next? Jerome Powell's term as Fed chair ends in May 2026. President Trump has already said he plans to nominate a new chair in early 2026 and has signaled that he wants someone more aggressive on rate cuts. Names like Kevin Hassett have been floated publicly, and Washington insiders say the decision could be announced well before Powell's term actually ends. Markets are watching closely because the identity of the next chair will tell us a lot about how far the Fed is willing to go with rate cuts and balance sheet expansion. So how do top economists see all this? Mohamed El-Erian, the chief economic advisor at Allianz, has been warning for years that the Fed risks making a new mistake by being too slow to cut, just as it was too slow to raise rates in 2021. He argues that waiting too long to ease increases the chance the Fed will later be forced into a more aggressive, recession-triggering cutting cycle. More recently, he's described the Fed's situation as a trilemma between inflation, jobs, and financial stability. Cut too little and you hurt employment. Cut too much and you stoke bubbles and instability. Larry Summers, the former U.S. Treasury Secretary, sees the world differently. In a recent interview, he argued that policy is already on the loose side and that the balance of risks is tilted more toward inflation than unemployment. His main fear is that the Fed will lose its grip on the 2% inflation target and allow an inflationary psychology to take hold. In simple terms, Summers thinks the biggest danger is the Fed becoming too soft, not too tight. Nobel-winning economist Paul Krugman, on the other hand, has been pointing to something else: bubbles. He's argued that the explosive rallies in AI-related stocks look eerily similar to the tech boom of the late 1990s. Recently, he noted that part of the reason these assets keep bouncing back after every scare is that investors expect the Fed to cut rates again soon. In his view, markets may be getting ahead of themselves, pricing in an endless Fed safety net. Ray Dalio adds yet another layer. He warns that if the Fed starts expanding its balance sheet again while also cutting rates and the government continues to run massive deficits, we'll be in a classic late debt cycle phase. That's when countries start quietly monetizing their debt, printing just enough money to keep the system going while slowly eroding the real value of cash. History shows that this phase can be very good for asset prices in the short term and very dangerous in the long term. So what does all this mean for 2026, for stocks, crypto, and the real economy? If the Fed continues cutting rates through 2026, ends QT, and begins some form of balance sheet expansion through reserve management purchases, it's hard to imagine that risk assets won't react. Lower yields generally make stocks more attractive compared to bonds. Growth sectors like tech and AI, already riding huge narratives, could see another wave of speculative buying. Corporate borrowing will likely become cheaper, encouraging stock buybacks and M&A. Many equity strategists already see the end of QT as a bullish signal for both bonds and stocks. Crypto, as always, reacts even more violently to liquidity. In 2019, the end of the previous QT coincided with a major bottom in altcoins and the start of a new upswing. Crypto analysts are already pointing out that QT officially ended on December 1st, 2025, and some are calling this the beginning of a new liquidity supercycle for Bitcoin and altcoins. Whether that's true or not, one thing is clear. Removing a major drain on dollar liquidity removes one of the headwinds that has been suppressing risk appetite. For the real economy, the picture is more mixed. According to the OECD, U.S. growth in 2026 is expected to be modest, around 1.7 to 2%, with inflation still likely above the old pre-pandemic norms. El-Erian has warned that lower-income Americans are already close to a personal recession, squeezed by higher prices and higher borrowing costs. Rate cuts and an end to QT could provide some relief, but they may also keep asset prices inflated and inequality high. So, we are left with a paradox. On one hand, the end of QT2 on December 1st, 2025, after starting back in June 2022, marks the end of a 3.5-year experiment in draining liquidity. It reduced the Fed's balance sheet by more than $2 trillion. On the other hand, the next phase, a world of rate cuts, a possible new chair more willing to ease, and quiet reserve management purchases, could fuel a powerful run in stocks, crypto, and other assets going into 2026. But it could also set us up for bigger problems later: more bubbles, more debt, and more instability. So here's the real question for 2026. Is this the beginning of a new golden period for risk assets, powered by easier money and a softer Fed? Or are we watching the early stages of the final phase of a long debt cycle, where every new round of easing solves today's problem by making tomorrow's bigger? The Fed has ended QT. A new chair is coming. Rate cuts are likely not finished. The money machine has changed gears again. The only real question now is, will you treat 2026 as just another year, or as the turning point it might actually be?